In this short video, I'm going to share with you the secrets and how to raise capital effectively, fast, and be successful at it. Hi, my name is Taimour Zaman. I run a company called Arcadia. We invest in things like real estate, artificial intelligence, blockchain companies. We invest millions and millions of dollars. And as a result, we see companies from Silicon Valley, Israel, Africa, like all around the world. On a weekly basis, I get 70 to 90 pitches a week. And certainly we don't go through all of them. And the companies that we invest, I think, are fantastic companies that I like, but they don't meet our fund's requirements. Some of them, I help them privately to raise capital. I'm very, very, very good at raising capital for the companies that I like. I thought I'll put together a short video on how to raise capital effectively because, quite frankly, I think most people do it incorrectly. And I also haven't seen any books or content online that shows how to do it correctly. And I thought, given the number of years and the number of pitches that I see, I should just put together the top 3 things that you should do differently if you want to be effective at raising capital. Before I get to that, I want to share with you how important raising capital is. My experience is if you're able to raise capital faster, better, cheaper, and more capital compared to your competitors, you'll outperform them any day. My experience is if the strategy of the management team is to raise capital, and your competitors could have whatever strategies they have, you can outperform your competitors. About 3 weeks ago, I came across a technology company that competes in a very, very, very aggressive tight margin space. And their management team's strategy was one thing. It wasn't about having a better mousetrap. It was about raising capital. That was the entire strategy. Q1, Q2, year 1, year 2, year 3. It was all about what's your strategy? Raising capital. It was not about having a better mousetrap. Because they raised capital and that was their primary focus, that allowed them or enabled them to hire the best salespeople that already had a book of business with them. So because they raised strategy, or because their strategy was raising capital, that enabled them to hire the best salespeople in the industry that came with a book of business. Most companies that I know of, privately held companies or publicly held companies, the management team often thinks about how can we increase revenues, the top line, how do we have a better mousetrap that would enable that. The part that I feel a lot of them miss the point on, or the bullet on, is raising capital. That's my experience. And if you can raise capital, you can enable or spend that money to have a better mousetrap. You can spend that money on having a better sales rep. But the area that you want to master, I believe, as a business executive, is the ability to raise capital effectively. Seeing a lot of pitches and also being very effective at raising capital myself, I thought I'll put together the 3 biggest mistakes most people do and how you could avoid it and do it correctly. Number 1 is your context to raising capital, who you're being about raising capital, thinking through about raising capital versus just hitting the market. The hitting the market is what I see a lot. And if I had a camera that I could show you about a guy, for instance, who wants to raise capital, it looks like this. And 99.999% of the people do this. It's like if you could imagine or picture a guy who's looking to have a girlfriend, and he goes to a bar and he talks to all the girls in the bar. And all the girls can see him getting rejected by this girl, getting rejected by that girl, getting rejected by that girl, like that. He just he wants to talk to all the girls. And then when he gets rejected, he goes to the next bar, and guess what? He does the same thing. It takes a lot of time and your energy to take that approach versus thinking something through. And I promise you, the people actually stop and think something through, people who actually invest time and energy into the setup of raising capital, outperform, outdo the bar scene example that I gave you. Thinking about raising capital and being strategic about it, you're not talking to every venture capital firm. You're not talking to every debt financing guy. You're very strategic in who you're talking to. That's a big one. When you approach them, because of who you're being and you've thought it through, how you approach them is different. Just on LinkedIn, I get messages, people saying, I've got a great opportunity for you. I want to show you this debt by PowerPoint presentation and you should get involved. A guy who's thought it through will say, I understand that you're interested in a conversation around AI, or you might be invested in real estate. Can I join the conversation? Like, their tone is different because they've thought it through. When you meet with them, they've thought it through, and you're far more interested in working with them than other people. And I'm saying this from the seat of a VC person. The second biggest mistake that I feel most people do is they get their valuation wrong. So this is the part that I might ask of you is to take a paper and pen, because I'm going to give you the correct formula to use and how to come up with evaluations. I understand that now this is the footnote for this piece of the conversation. I understand there's something called hype money. As of the date that I'm shooting this video, hype money seems to be in things like cannabis, which is awesome. And the valuations that people think about their cannabis business, they're looking for hype money as some ridiculous number. That just, if you're a smart investor or venture capital firm and you've got shareholders, I don't know, you just want to be careful about where you're putting that money in. So other than hype money, like 5 years ago, hype money was in blockchain. There's always some kind of people are looking for hype money, and I kind of get that. I appreciate that. For people who are not interested in the hype money business, I'm going to give you a evaluation formula that is accurate, correct. And if you're pitching it to in China, Middle East, North America, as long as you use the formula that I'm about to give you, people, it makes sense. It's not, you don't have to get into an argument or fight about what you think the valuation is versus what the firm, what the VC think your valuation is. So here's how you do it. Number one thing you have to figure out is, what are your assets in your company? Is it cash? Is it IP? What are your assets? Second thing you have to figure out is, if I can think about A, is what are your assets? B is, what do you owe on those assets? Do you borrow money, as example? Like, what do you owe on that asset? And then C is A minus B equals C. So what are the assets? B, what do you owe on those assets? And C is if you subtract that, you come up with a number. And then multiply that number by 2. Don't multiply by 10. Don't multiply by 200. Just multiply by 2, and that's the valuation of your company. I've seen people that have a conversation with a client, a potential client, and potential client makes a promise that they're going to get this big order. That's not a valuation of your company. Just because I had a conversation with my brother-in-law and he's going to come next Friday to my house for dinner, it doesn't mean he's come to dinner. It doesn't mean I fed him dinner. It just doesn't mean anything. These kind of conversations are really awesome. Just do me a favor, don't put that into your presentation. So what you think the valuation is, because you had a conversation with somebody. Just trust me, I see 70 to 90 pitches a week. Skip this part. Just use the formula I gave you and it works. What are the assets? What do I own that asset? Subtract the 2, whatever it is, multiply by 2. And that's a conservative number for what the valuation of a company is. Now, if you're a startup and you don't have that, then what you want to do is you want to look for a lookalike. You want to look for who has been in your space, who's done that, and then have here's a lookalike, and then use that as your number. The third biggest mistake I find most people do, if not everybody, is that they talk, when they do the death by PowerPoint presentation, they talk about how great they are, how great their company is, and like that. And I want to tell you that's really awesome. Every venture capital firm that I know is in the business of making money, period. We're in the business of making money. We're not in the business of hearing how great you think you are or how great you think your product or service is. We're just not in that business. So skip the how great you think you are, and every slide has to be about how I make money, how I make money, how I make money. If your headline doesn't talk about how I make money, don't put that headline, skip the slide. If you're really gung-ho about it, do it on your spare time. Sit down in the mirror and do your presentation to yourself about how great you are and how great your product or service is. Just don't do it to the VC community. That's my experience. On the Death by PowerPoint presentation, I get lots of questions. Well, what do you want to see in a presentation? Well, first, I want to know what the product, service, or idea is and how I can make money out of it. Second, I want to know why this is a better mousetrap compared to any of your competitors out there and how I can make money out of it. Third thing, I want to know if you have what it takes to execute on that idea. Do you have the management team? If you don't have a management team, do me a favor. Don't go get me a advisory board that's made out of your father-in-law, brother-in-law, best friend. That doesn't count. Now, I'm using the bad analogy of the mother-in-law and the father-in-law, but really a lot of people do is they reach out to industry experts or people that they like and bring them in as a loose advisory board. Let me tell you about me. If I'm putting my hard-earned money into your company, I don't care about that. I care about security of my capital. What that means is you go get an independent board of directors who have oversight about the money that you want from me. And that just takes off this, I really like this guy and I'm going to have him to be part of my advisory board. No, the correct approach you want to take is what's the skill set you don't have that you need. That skill set that you don't have you need, you want to go get these guys to be a board of your directors and then have oversight into the operations and the funding. And a board of directors doesn't have to be 60 people. It's like 5 people. And you and your best friend, your CFO, CEO, whoever, can be part of the management team. So you're not giving me control to anybody. But if you want to raise capital correctly, I'm here to suggest that venture capital firms want some kind of a security of that capital, want some kind of oversight over that capital, and having a board of directors and having all the legal work between you and board of directors secure before you come to funding. I understand that there's time and cost involved in setting up a board of directors, but you investing that time ahead of going to the VC community will consistently save you time in raising money. You can raise money faster, cheaper, better. That's what I think. So on the debt by PowerPoint presentation, what's this big idea? How does it make me money? Why do you have a better mousetrap? How does it make me money? Have you done this before? If not, who's in your management team? Who's in your board of directors? And have they done this before? Like that. What's my exit plan? What's the intended rate of return? And how soon can I make money out of it? That's pretty much your PowerPoint presentation. It should be done in like 5 slides. Like that. Now, what you want to know from us is before we met you or before we're going to boardroom to talk to you, we've talked to, there's been somebody else before you. And after we meet you, there's somebody else who's coming after you. So you are competing for a little bit of attention time with a lot of noise out there. My invitation for you to strongly consider is if you're not a good storyteller, hire somebody who's a good storyteller. Like, I don't know how to say this. If you want to be cheap about it, I don't know what to say. Go take a course on storytelling. There's great schools like Second City Communications that train people on how to be actors. Go do a course on that kind of thing. It's worth the time because if you get trained on storytelling, I think you can pitch better. You can get up attention better. You can hire salespeople or other employees and retain them better because you're a good storyteller. And if you don't want to do that, my invitation is hire a former CEO or CFO that has 2 fundamental things. A, they've raised capital, and B, they're really good storytellers. Looking for those 2 and having them present your story to a group of VCs will go far more than if you're not a good storyteller for you to try to give us a death by PowerPoint. So that's it. Those are the big ahas, insights that I want to share with you. My name is Taimour Zaman, and raising capital is really important. And if you ever need to raise capital, now you know a guy you can give a shout to. Looking forward to working with you.